This teaching, we're going to talk about propulsion blocks. And a propulsion block is a candle or bar that is previously traded down into a down candle or bullish order block and takes over the role of price support for higher price movement. In this example here, okay, in this crude diagram, we have a down candle, which shows price willingness to move higher. And then we have a new down close candle that trades right back into it, seen here. That candle becomes a propulsion candle. What makes it propulsion is that it's already dropped back down into an order block that's already predisposed to go higher. Then we created another higher order block that touches the initial one. That new higher level bullish order block or down close candle will be highly sensitive. It should never see the mean threshold break half of the body's height or the middle of the range of that candle's body. That mean threshold should not give way. The sensitivity is going to be very much more amplified when it trades back down into the high, but we are willing to allow it to still trade down in the middle of the range or mean threshold, but it most likely it will never do that. It just trades down into the high of the candle and it immediately explodes. It may go pip or two below the high of that particular down candle, which we're naming as a propulsion block. The market will show a sudden and violent movement away from that down candle. That's a propulsion candle. Let's take a look at it in price action to get a better feel for what it looks like. Okay, let's take a look at a bullish propulsion candle. Okay, you can see the price has moved from a low here, and we're on the buy side of the curve, and the market has several down candles in here. So we would take this as one full bearish candle because it's consecutively 3 down candles. So the bullish order block is framed like this. So we have equilibrium down here. Price trades all the way down to this level here, but falls short of equilibrium. So we have a level at which price could reasonably trade down into, but it doesn't do it here. So price trades lower here and then rallies through its own 3 consecutive down candles. So this is an order block as well, together, all 3 candles. And then we have this candle right here. Okay, see this down candle? It's trading into these down candles together. So this is all one bullish order block because it's all down price movement, reaching for a level to buy, and then price moves through. This candle here trades through the highest of the down candles. So that confirms this is a bullish order block. The very next candle trades higher, and the next candle opens and trades down into this candle here. When this candle creates the down close and closes, this becomes a propulsion candle. What makes it a propulsion candle is that we are trading another down candle into a previous down candle when the underlying context is bullish. The powerful nature to a propulsion candle is you don't ever really see a mean threshold violation on it. So if you get an opportunity to see it trade back down into, as it does here, this candle opens, trades down into it right there. The open comes in at 133.45. The low on this candle comes in at 133.45. Goes right to that candle. So that's a bullish entry here with a propulsion candle. And again, all it is a down closed candle that trades down into a previous down closed candle, or in this case, this is a 15-minute time frame. I don't have a way of showing you a 45-minute chart here, but it's the same price action that we've seen here. The down candle trades into this order block that would be bullish, and then we see price trade higher and then come right back down into this candle here. This is the propulsion candle. That means we should see immediate responsiveness on bullish price movement higher off this down candle should it trade back down into it again. Here's the clue. If we break the mean threshold of that type of candle where it's already traded down into a previous order block, it's bullish. If this loses its mean threshold, chances are it's probably not a good trade. So that means you can have a really ultra tight stop loss on your long entry, or you can have immediate feedback that you're on the wrong side of the marketplace and you probably are better off either going to the sidelines or many times looking for a reversal to go short. Okay, we're going to look at an example of a bearish propulsion candle. Okay, we're going to frame it around a higher bearish order block. It's this candle right here. Price trades up into it here, breaks down. So now we're going to add another level of order block theory. So we have this last up candle. That's the bearish order block here, referencing this one as well. So now watch what happens. We have price movement lower, then we trade right back to this order block right here. This candle becomes the propulsion candle right there, this one. So now we can cut that candle in half right here. Boom, hits it right there, mean threshold, trades immediately lower. This is a sell entry on the propulsion candle that's bearish. We could be a seller there. And we can also use a entry at a later time where it trades right back into this candle's low, where it trades right here, hits it, responsiveness immediately moves lower. So look at the responsiveness after it trades into this candle. You have to see it break below this candle's low, which it does here. Okay, it's already showing a willingness to not want to go above that mean threshold here, but it breaks down, then trades right back up into this candle's low. It doesn't need to go up to the body. It's the low of the candle on the propulsion candle. It's going to be very, very sensitive. Hits it, immediate, quick responsiveness as you would expect. And that's why I gave you the name, the propulsion candle, because it propels price quickly and suddenly, and it gives you immediate feedback. Very little drawdown, immediate price responsiveness. That's exactly what we're looking for as short-term traders.
When we leave this consolidation inside this order block, it drops down into it here. Mean threshold is half of the order block. So half of this range. This is what you want to do with your fair value gaps and what you think is an order block. In my mind, I'm watching on a bullish order block, I'm watching the high to the midpoint. I want to see it show a willingness to support price, preferably hit it and quit it and run the other direction real quick. That's what I'm really looking for. But if it starts doing this, and as long as it's respecting that midpoint down here, I'm okay with it. In this instance, using the order block, I'm going in right there at that price. I'd be going long on the first return to it there. So I would go long 6 contracts there. As it's digging down, I'm going to watch. Does it want to go to the mean threshold? Mean threshold is half of an order block, or half of a breaker, or half of a mitigation block. Then I would buy 3 right here on this candle as it hits the mean threshold. So now would be long 9 contracts. If it runs like it does here, and then one more time pumps into it one more time, then I'll do my one last contract, and I'd be long net 10 contracts. 6, 3, 1. Hoping that I can get the little wick through the midpoint, trusting that it isn't going to go the other side. How can you trust it, ICT? Experience, knowing that it's likely to do what I'm explaining here, and also being comfortable with being wrong, because I can be wrong and be profitable. I can be right and be not as profitable as I should have been. There's a gray area where experience dictates the outcome. When we see this range here, the midpoint of the order block, once it leaves it, okay, once it leaves that, what's this candle right here? This is a propulsion block. It's an order block within this order block. So it's a nested level. I love this formation. I love it. Let me show you why I love it. What's the opening price? What's the opening price on the candle right there? 4029.25. That price to its high right in here, that is one of the most sensitive bullish order blocks. Responsive, quick, sudden, like you want to see a dynamic movement, it's going to really do it on this. Show me the order blocks that work. Well, here's that lesson. This opening price to its high, that is the absolute most sensitive area in order block theory, 4,029.25. It goes through it. It leaves it on this candle. Does it not? The next candle we open here, what's the low of that candle? 4029.25. Wait a minute. Deja vu. Something different here. No, it's exactly the same. The run in price here, you have several things you can look at. You have the buy side relative equal highs here. So we have buy side here. And also, what is the highest closing price? I'm going to walk through the PD array matrix with you, okay? And what else do you have? What's the highest high? Right there. So this high, what have I taught you about that? Wicks are gaps. What? Wicks are gaps. Midpoint of that gap is consequent encroachment. It's 4,036 even. What is the closing price on that candle? 4,036 even. Yes, there's a small little wick. I'm caring more specifically about the bodies, because the bodies are going to tell you the narrative. The wicks are where the damage is done. Does it offer from this point here, buying into the propulsion block, from here to the first rejection block right here? That's the first of your premium arrays. Does it offer 5 handles there? What does it leave? It's a fair value gap, isn't it? How do you know it's going to stay open? The propulsion block It should stay open. It should not fill in. This would act as what? A breakaway gap. So if this is breaking away, I'm going to expect what? Price delivery to be more bullish candles, very little retracement, and maybe 1 or 2 down close candles. Everything else be what? Bullish delivery. Buy side being offered. How many down close candles do you have from the propulsion block to the consequent encroachment of the wick? You have 1 down close candle. Why is that important? You need to know the difference between signatures that are going to be favorable for you. If you start seeing a lot of consolidation and down close candles forming and booking in a price run that you're in, chances are you're probably going to hit a retracement and come back on your stop loss, or it's not going to go in your favor anyway. So I'm looking at how does price continuously deliver. Is it giving me bullish candles? Is it staying bullish each time? With the exception of this candle here, every candle was bullish. And I'm not worrying about all the little whipsaws back and forth because I'm not going to ram my stop loss up there, theoretically, because I want to see it do what? I wouldn't even roll my stop up until this short-term high was taken out, because above that is what? A very small pool of buy-side liquidity. Buy stops. Anyone that's short, they would have trailed it from here to here. And then we move back into consolidation. And we're entering what time of day? Noon. That's lunch. Most of the time, you're going to be squaring your
Notice when we had this low broken here, that's a change in market structure. So it changes from bullish to bearish. Thursday is what day of the week? That's the day that generally caps the weekly range. Now, when it doesn't, Wednesday could always be a factor. Now, here's one of the takeaways from this lesson today, because we're talking about weekly profiles, completing PD arrays. In other words, we traded up into a premium array that we were anticipating as an upside target. We were inside the volume imbalance, then we noted the gap, and then we have all of these signatures completing, consequent encroachment. The question is where does the interbank algorithm change its state of delivery from bullish to bearish? Yes, we've seen the break in the market structure there, but when does the algorithm actually change its state of delivery? Last up close candles. Notice this candle's close is higher than this one over here. Even though this one wicks through, this is the order block. These 3 consecutive up close candles, that is your bearish order block. The opening price there, if price trades below that, which it does right there, that is exactly when the change in the state of delivery occurs. So we had a bullish delivery, and then it becomes bearish right there at that moment. That right there is what makes the order block an order block. But this change in the state of delivery, the algorithm is now changing gears and now moving the price lower. Not buyers coming in or sellers coming in and influencing the market because of their pressure. That's not what this is. It's the changing of the state of delivery, which occurs right there. Now, that's not the only one. You have a secondary one right here. So we have an up close candle, again, prior to this decline. So this is your bearish order block. This is your bearish propulsion candle. Okay, so this propulsion block eats into this bearish order block. And then we have a change in the state of delivery again, right there. Now, when that occurs, yes, we have a fair value gap there that can come back up and trade into that, but it's not likely to. And you have to have 2 procedures that begin at that moment. Always anticipate the likelihood of this coming back up into fill, but I'll show you what you have to do in terms of hierarchy for logic. Okay, so from a programmer's stance and also how the algorithm will refer to these PD arrays, this could always be a bearish order block that's traded back up into. But all of this narrative here will cancel that out in a moment as I go back through with you. So the change in the state of delivery going lower begins right at that opening price on this candle. As soon as it trades through it, now the algorithm is delivering on a sell side. So basically, the algorithm enters a sell program. Once this occurs, price will start to go lower, attacking what? Any imbalance or sell side liquidity. Now, looking left of this opening price, where is there an imbalance? Because it's already seen it trade down, came back up, and then we came down again, and came back up again, and then left it. So it's not coming down to get an imbalance. It's going down here for liquidity, sell side liquidity. But now that run on the sell side liquidity coupled with the PD arrays that's been complete up here and we have change in the state of delivery, we can refer to this opening price and this new low. This right here is an IPTA data range for dealing. So in other words, an IPTA dealing range. So we're looking at the opening price down to that low, trades back up into that daily bearish order block, and sells off. Opening price on this bearish order block, drawn down to that low. I only extended it over to the right, so that way you can see how it trades up into optimal trade entry. So at the 62% retracement level there, we are definitely inside of a premium relative to this opening price and that low. So it trades back up in. Now, if you pull a fib from, say, this high to that low, you do not get an optimal trade entry. But I taught you recently using where the market changes its state of delivery. If you put your fib there and anchor it down to your swing low or up to your swing highs, you'll see the Fibonacci's line up perfectly for optimal trade entry. The logic is understanding that we had a breaker over here that completed at a premium array. We gave it the possibility, or anticipated it rather, continuing on Thursday, and then maybe Thursday creating the high of the week as it trades up into the remaining portion of that volume imbalance premium high. But it didn't do that, and we'll come back to that in a moment. Now we're going to look at the secondary change in the state of delivery, which is this low here at the opening price there. When it creates that up close candle, draw your fib from that down to the low, same thing. You get essentially the 70.5 level, but optimal trade entry nonetheless. Market breaks away from that optimal trade entry and daily bearish order block. Breaks lower. We have no change in the state of delivery there, which is also what? Bearish order block. So once the market starts to break down, yes, it can always come back up into that level, but not if we have something like this. We have the up close candle down, it leaves that order block. Then the next candle here, we open and trade back up into it immediately. So this very quick return back into the bearish order block, in my mind, cancels any necessity for it to come back up to it again, because what is this candle? We have the bearish order block and then this. What is this? That's a propulsion block or propulsion candle. It's eating into essentially half or less than the bearish order block. Immediately, as soon as you see that, right after that candle is usually when the big move of repricing goes lower. Look at the signatures in this one as well. We have the up close candles, which is all consecutively one bearish order block. The market trades into it again here, essentially about halfway there. Once this candle closes, I'm anticipating range expansion. I'm expecting big ranges. It's going to take off and start moving in my direction because it's all based on the propulsion block. Okay, so we have this candle here. Immediately what happens? Boom, the big move begins. Here, bearish order block, propulsion candle, boom, the big move begins. Okay, you see how that works? So now that is reversed, obviously, for anything that would be a bullish market. Propulsion blocks are essentially a timing mechanism for me and all other interbank traders to know when the big move is going to begin. So if you've missed it, you pretty much, you're done. You got to use either a institutional order flow entry, or you let it go. You don't chase it. Because as far as that move is done in terms of an order block, propulsion, that's why I dubbed it propulsion, because it propels price away from the original order block. Propulsion block repels price away from the original order block. This is smart money entry. This is low risk short. Same thing with market maker sell models. Smart money reversal, selling in that candle. Low risk short. Boom, takes off. Okay, you're learning some good stuff here today. So we have a bearish order block level here. We'll look at this when we drop into the 15-minute time frame. Dropping into the 15-minute time frame, okay, you can see that same daily bearish order block level and the hourly bearish order block level. And we see the market trade back up in and then breaks down. So we have what occurring again? A fractal formation of what we've already shown on the hourly chart. It's just being shown on a 15-minute time frame. We have a sell side liquidity pool here, then the hourly 60-minute fair value gap.
If you look at what we have, the time of day here and the next one's here. Okay, so what I'm watching is we had already traded up into this volume imbalance there. We went lower, and then we went one more time, bumped it. And remember I was telling you earlier that the bodies of the candles can go just a little bit outside of the PD array. The high of that PD array is this candle's close. So when we went above it here with this candle's close, the fact that it did that, it's so subtle that it's permissible. I allow that to happen and not change anything that I expect in price action. So when my algorithm is behaving like this, I am not looking at price and saying, oh, well, it's broken or they changed it. They didn't change anything. It's doing everything it's normally going to do. And the next candle confirms it because it stays where? Inside of that volume imbalance. So the market shows a willingness to go lower. So we had stops taken here. The market drops. And then right in here, what is this? If this run up takes out the liquidity and this gap with this volume imbalance, anyone else that doesn't know really what's going on, they may look at that and say, oh, this is a buy, and then look for it to go higher. So you can see that we have this inefficiency that's overlapped. I love the fact that when we drop down and we had this little wick, that little wick right there is a mohawk. This is what I refer to as a mohawk. Now, a mohawk is just where price has been allowed and you as the analyst afford it to behave in a certain manner that is just outside of what would be perfect. Perfect would be to stop it right at that candle's open because there's a volume imbalance. Whenever you have a volume imbalance that's part of a buy side imbalance or sell side inefficiency, you cannot just use the low of the wick. You got to use the volume imbalance. That's the true range of that inefficiency. Because you have two PD arrays agreeing with the same context, the price being offered strongly with buy side, inefficient in sell side. That means it's got to offer this type of price action where it's dropping down over that same range between this candle's high and this candle's open, which is the volume imbalance. So we have now two deliveries, up and down. And then we have this. One more attempt to do something above it, and it wicks. See that? It wicks. That little tiny coloring outside the lines of that volume imbalance high, that right there and where we close with the bodies tells me that this should drop lower. The next candle we open drops lower. One more time to consequent encroachment. We break lower. We create an order block. This order block is part of this one. What kind of order block would this be? Propulsion block. So we have order block that reaches the high end of the inefficiency over here. There, it drops. This one here, this candle's body cannot breach half of the order block that it's trading back into. When you get that, it's kind of like a tipping of the hand. It says, we have an order block that should send price lower, and then there's another one that's digging into that previous order block. So you're really getting a lot of conviction placed around the idea that prices should be repelling away from this one and certainly away from this one. But we have this order block forming inside of a inefficiency. And the consequent encroachment of that inefficiency is right here. See that? So we wick up into, I was using this order block as my initial entry. You'll see it when I put the executions back on. I'll put my cursor so you can see where those entries were. And then as we went into consequent encroachment of this wick, as soon as we hit half of that right there, I went in on that candle. I'll take that too. I'm not afraid that it might go higher. Why am I not afraid? Because I have an inefficiency here that has changed into an inversion. This is a little coloring outside lines. Could it hold on to that? No. And then we closed here, not at the high of the fair value gap, near the metal. And then the next one we do what? We confirm it. We open, trade outside of it. So what is it done here on that candle? It's left this gap energetically, and look how it closed. So that means we can still trade up to consequent encroachment of this inefficiency because that's normal. And it could be normal through the lens of the wick doing it only. What do we see here? We open, the body goes all the way up here, stops just by a little bit. So that little movement above that midpoint of this inefficiency is the same thing I've outlined here. That's a mohawk. So you would do the same thing here. But when it's a bold-faced bullish candle and it's all the way at the highest high, it's going to be terrifying to you in the beginning. You're going to second guess everything. And the market comes down here and closes outside the fair value gap, validating this right here. So this is just returning back to a level that's permissible. Then the market opens, indecisive candle. We want to see it drop away. It does. Now we know that this is a propulsion block. Why? Because its candlestick body did not close above or cross mid part of this candlestick, which is the order block. The propulsion block, its entire range needs to be referred to. And it went just a little bit above halfway point of that inefficiency. Now we're expecting this to be treated as an inversion fair value gap. So this is now inversion fair value gap. Whenever I have a range like this that's highlighting a fair value gap, if it's ever a hue, it's an orange, what I'm saying is its role has reversed. So whatever it would have been initially expected to deliver over here, dropping down, it should go higher. That's what the myopic view is. But then when it gives up the ghost and leaves it here, and then we get it confirmed there, everything going future, allow for it to trade back up into here, but stay out of what? What should it stay out of? What should price not do? Explore in the upper part. That means this. This shaded area here should not be traded to in this inefficiency. We worked the lower half of it. We mohawked above it. But this portion, so this is the portion, if it's really valid, if it's very, very strong, if it's going to send price lower, we will be encouraged and we'll know we're on side. That means we're on the right side of the marketplace. If any rallies that can be done with a wick, because the wicks can do what? The damage. That running up into that, we should not be fearful of that. We should be comfortable with it. And my stop loss was above the rejection block, which is the up close in this swing here. We have high, higher high, lower high. The up close, the highest up close in there. So I used the rejection block because it's already worked it here. We traded above that closing price on the next candle. Then it rejected it. We went right up to it here and delivered the same price. It needs to be traded to one time, and then if it's good, it should not go back there again. And here it is. It stops dead in its tracks. It never goes above it. See that? And then this little run here, it's me using this wick. So I measure, and this is, now I'm sharing this logic with you, so that way every example I show in the future, you're going to see that if I'm using trade formations like this, it's the same logic repeating. But that is consequent encroachment. And as it slammed up into that, I said, oh, I'll take that too. Trusting that my stop loss is not going to get hit because of the logic I just outlined all here. So as it went up there, as it jammed up there like that, as soon as it jammed up in there and hit that wick, because I was looking for it, I said, watch this right here. And then poof, it slams up into it. As soon as it touches the consequent encroachment at that level, I'm hammering it right at the market, selling more. Now, I'm expecting, because it did this, it should not trade back into this portion of this inefficiency. Okay, so in other words, I don't want to see the upper half traded to. I want it to stay keeping that portion open. Because we had so many qualifiers in here saying that the rejection block has done its job. That's algorithmic. That high happens to be the same price of that closing price. So everybody's buying and selling pressure just happen to agree. When we're looking at how the market drops away from this right here, this consequent encroachment, is not going to go back to the rejection block. So I'm not freaking out that my stop's going to get hit. So I'm using the same logic. And you're all questioning, dude, please teach stop placement. Please teach how you're putting the stop losses where, how I need to get that skill. You're learning it right here. Every single time I lecture and I teach, I'm teaching that. But it's one component that needs to be relying on other things that are supportive. There's so many things that have to lean on one another for it to mesh perfectly. Just because that's, a inversion fair value gap potentially there, doesn't mean that I'm going to trade it unless I have other things supporting it, like an order block. An order block has to have other things around it. It's not just an up close candle, and it's certainly not just the last up close candle before the down move. So the market gives me a perfect execution for another pyramided entry. So as it slams into that level right there, I'm confident that it's not going to rejection block, which is this up close candle's closing price. Because everything I've outlined here has fortified and solidified my confidence is valid, and I don't need to worry about it. It's not going to my stop. So if it gives me another premium level, which is this one here, because it should not touch the low of that upper half of that inefficiency. Why? Because when it's bearish, the upper half, the premium aspect of that individual PD array, the upper half Once it leaves it, or it assumes that it should not come back there, in my mind, I want to see that area fail to ever be redelivered to. Here's the first one. I'm hammering the opening price right here on the projection block. Propulsion block, rather. The propulsion block, I'm hammering it as it hits it there. And then the next candle gives me even better placement, which is the consequent encroachment of that wick. And right there it is. See it? Look right there. Beautiful placement there. Hits it, falls short of the bottom of that inefficiencies, upper half. And then I want to see price start to get heavy, start to get real heavy. And the low on Monday, the liquidity below the previous day's lows, the highest high and the lowest low in the last 3 trading days, you have to have that information all the time. The last 3 days, whatever the highest high was and the lowest low, you have to have that information because the market will refer back to that. The previous day's high and the previous day prior to that. So what you're looking for is the highest high and the lowest low in the last 3 days. Then you're looking at the high and the low of the day 3 days ago. It's not the same thing. Listen to what I just said, the highest high and lowest low, because you're going to also refer to, like for instance, say today's Tuesday, we're going to look at Monday's highest high, lowest low of the day, or its daily range, high and low. Then you're going to look at Friday's high and low, and then Thursday's high and low, not Sundays. Sundays are treated differently. The only information I pull from Sunday is the opening on the new week opening gap. I don't to, crossing over to midnight and New York local time. I don't care about that. I'm looking just for the opening gaps that form on Sunday's 6 p.m. opening. That's Forex and that is futures. It's everything. Okay. Apart from that, Sundays are a nothing burger to me. But that's really important information looking at where we open at on a new week, because you can take that information that's been proven here, you extend that out in time, and it's useful for weeks and months. And it's alien to people prior to not learning it from me. They had no idea that it's even there. But look how many times there's setups. Look how many setups that form, how many times it gives you a draw on liquidity. Main thing is daily highs and lows, the liquidity above and below those reference points. You want to have that in your list of things to observe. They will act as draws on liquidity. The market will gravitate to those, just like a new week opening gap, just like a new day opening gap. So it helps you understand liquidity. It helps you have a steady supply, never running out of setups. You're never going to run out of yeast as a baker, okay? You're never, ever going to be shortchanged on opportunity, because there's always going to be a previous day's high and a previous day's low. The liquidity below the previous day's low, and when we start getting in close proximity to it, okay? So what that means is we're watching price dropping down, and everything in price action was supporting the idea that it's going to keep going. How do I know that? How can you know that? How can you trust that it isn't going to reverse? Like you're trading inside this area here, like while you're looking at the price lights. Like when you see that, what are you trusting? What are you leaning on? What's the logic that tells you this is going to keep dropping, ICT? Well, number one, it's trying to get down to the previous day's low where there's real orders resting below that. What kind of orders? Sell stops. Okay. So if I know that we're pretty uniform in the way we keep dropping, my eye goes to what I teach you. This candlestick right here is an order block. If I find that, and then every subsequent candle after that, to the right as it's forming, as we move away from it, if it comes back up into this candlestick, is it able to overtake half of this candlestick? I'm teaching you order flow. This is real order flow. So here is half of that order block. Okay. Did this candlestick or this candlestick come up and touch that halfway point, or which would be mean threshold? No. That's exactly what I want to see on an order block. Okay. The market trades lower. This candlestick trades up into this candlestick. So what does that make this? Propulsion block. So price should do what? It should trade away from that. Now, in this little area right here, we have a volume imbalance. That's what this order block delivers to. This candlestick, and this candlestick is working inside of this inefficiency where we had the body here. This candle's indecisive. It's just basically the open and close is the same price, and we have a high and a low. That's indecisive. Usually when you see an indecisive candle like that, you're building a volume imbalance. And the next candle, you'll see it's there. Boom. But the rally back up just fills in that little void there. It's no bodies. It's absent of having any bodies. So the market will do patchwork. The algorithm is doing patchwork where it fills in these inefficiencies. Okay, so when it does that, then the market displaces and goes lower. At this moment, we can now see it goes back up, trades one more time. What is it digging into? The original order block. That is a reclaimed bearish order block. Why? Because we've already moved away from it and it's coming right back up into it here. It needs to show immediate response, drop lower. Does it? Yes, it does. And then we retrace back into this little area here, fair value gap, trades back up into it, hits it. Does that send price lower? Yes. Price displaces lower, takes out this low, trades up into this area here, matches the high here. Does it have any willingness to get up in this inefficiency? No. And then breaks lower right there. What I have right there is a market indicating in every shape, facet, or form that it's heavy. It means it's really, really heavy and it's going to be easy for it to fall. The heaviness in price is proven right here. So I'm confident that when we traded up into this area here, I'm not going to see the upper half of this close in. Watch. See that? Now, what have I been teaching in the 2024 mentorship? PV arrays, the highest form, the highest order of order flow around them is when you're bearish, the upper half are not traded to. When they're bullish, the lower half are not traded to. But the upper half here never trades to it there. So I'm getting short on this candlestick as it's already proven here, here, and here, and I need to be in. I need to be in on the move. So that's here. I do trust that we're not going in the upper half of this range here. So this is what I'm visually seeing. It's not going to go up into this portion here. That's my belief. Why? Because everything all through here is indicating that it's heavy. We're real heavy. We couldn't even do institutional order flow entry drill here, and we had this big drop down. Now, when you're watching this might feel like, oh, well, it's been dropping. It's got to turn around. It's got to turn around. It keeps dropping. That's not what I'm thinking. Why? Why am I not thinking that? Because this is the previous day's low. It's indicating every way it can that is in a hurry to go down below the previous day's low. The previous day's low is like a honeypot. It literally is like a honeypot. It's always there every single day, previous day's high and previous day's low. If we open in the lower half of the previous day's range, you should always look for some kind of return back to the previous day's low. That's simple market 101. Like it's a normal thing for that to happen. I am not wanting it to trade up here. Once it does all these things in here, I want to be in on the trade because I know it's getting ready to take off. The very next candle, what does it do? It opens and off to the races we go. And then we create what? Another opportunity for it to create a volume imbalance in here. So I'm expecting price to, it opens, it trades back up into this candlestick's range. When this candle opens up here, I'm watching to see it dig back up into this candle. I am trusting that it's not going to go back under the upper half. So I just want to get in any portion of this lower part of this candlestick. Watch my fill. See it? Here's the low of that candle right there. It opens and it's digging into this portion of the range. I want to add to it. There you go. Selling more. And then I get another opportunity here. What's it digging into? The volume imbalance. I want to be filled there. As the candle's going up, I'm filled it right there, bang. And then what does the market do? Rolls over, energetically runs right below some random level, the previous day's low. And there it is. But tell me how that logic right there, I couldn't have made that any better. To get that exit price, I have to have the fill that the low of the candle forms. So anticipating this large range is down, incoming in the recording, is because we were approaching Monday's low, and it's going to dig aggressively and fast to get down there and get those orders. Because as it's going closer to that previous day's low, anyone that has their stop down there has the ability to do what? Quickly say, I'm getting out and I'm going to protect myself and remove the order. So the first run into them is always going to be fast and sudden. Boom, sudden, real quick, because they don't want to let them pull the order. And that's the signature that when I am saying I'm expecting speed, I want to see distance and speed, or I want to see the magnitude of the move to increase right here. I'm indicating that I'm expecting the pool of liquidity that's next in order of business going lower or higher. They're going to quickly run for that because they are not going to let them pull those orders. So as the algorithm delivers lower, 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 when it gets in a proximity of this low, it will naturally speed up. What does that mean? It does not matter how many people are coming in to buy it. And it doesn't matter how many people are selling short. That's why when you're watching price, it's here, then it's here, and you think it took a long time for that 1 minute candle to do all that. It's gapping down. It's very speedily dropping, and it keeps offering lower prices, and it gaps lower and lower and lower and lower. And inside these individual candles, look at them, study them. If you have access to do like a 1 second chart, 5 second chart, you'll see it's porous price action. It's not a smooth one single candlestick of movement going lower. It's jumping and skipping down there because it needs to get quickly down below that previous day's low. That's a mechanism that's coded inside of the algorithm, which cancels pulling here. It's jumping and skipping real fast to get down to those orders. It doesn't need but one contract to book that price. One contract. That's all it's doing. It's going down here no matter how many people are buying and selling it. And the sooner you realize that, the easier this becomes. Think. If it's logic, that's sound, and it repeats, then you should be able to go in the charts and see it repeating. What is it doing over here? We have a low, a lower low, it digs in one more time. Right in here. So it's absorbed all of the liquidity below Monday's low.